Well, good morning, ladies and gentlemen. First of all, I would like to thank Iafei and ANDAF for inviting me to this 45th Congress of Iafei. And I'm very glad to be able to address you on this topic, which has been chosen for me, regulation and growth. Let me briefly move on to my slides. As it has been said eloquently by Romano Prodi, I think we have a situation in which the global economy has not really fully recovered from the global crisis, despite the fact that financial regulation has been generally tightened, and the Financial Stability Board, which is the institution in charge of financial regulation worldwide, has completed a comprehensive agenda of regulatory reform, which has involved higher capital and higher liquidity requirements. But as has been said, the IMF has just released a new forecast for slower growth. So the question is, and I'm talking mostly about financial regulation, is regulation hampering growth? So we have a situation in which we are talking about regulation versus growth rather than regulation and growth. Well, normally banks complain that higher capital requirements are an obstacle to lending. But as it has been argued by the central banking community and also by President Draghi of the European Central Bank, banks that have a stronger capital base are in fact in a position to lend more and not less. So the thesis is not convincing, and there might be other factors that play a role in the growth picture. And okay, so two other explanations have been put forward. One is that there is a debt overhang, both private and public, which breaks consumption and investment. This is a thesis has been basically theorized by Professor Kenneth Rogoff of Harvard University. The second explanation is that the world economy, after a phase of strong growth in the past, has now entered a phase of secular stagnation. This is the thesis that has been made by Professor Larry Summers. I think these two theses do have certain elements to play in the picture, but I will argue that there is another factor, and these are the fault lines that, in my view, characterize the international monetary system, and that these cause global monetary and financial instability, which in turn is harmful to growth. Let me briefly describe, what is the international monetary system today. And I think the international monetary system has become market-led in the sense that global financial markets are responsible for the creation and distribution of international liquidity and also the level of exchange rates. And of course, global financial markets constantly change the composition of investment portfolio, and because they optimize the combination of risk and return, but they also tend to react in the same way, in a uniform way, to changes in economic situation and the policy stances of key countries, both the advanced economies and the emerging economies. Now, the result of that is that capital flows move periodically in and out of main regions of the global economy, and they cause sometimes excessive credit creation, followed by sharp credit contraction, so-called boom and bust, and then volatility in financial asset prices, bond prices and stock prices, but also exchange rates. The working of the international monetary system is that after the global crisis, we have a legacy of slow growth and low inflation, and with the risk of secular stagnation and deflation. And in order to counter such risk, the advanced economies have adopted expansionary monetary policies, so famous quantitative easing, pushing interest rates to the zero lower bound. Now, with interest rates at the zero lower bound, the impact of quantitative easing is mostly on exchange rates. Therefore, you have the domestic monetary action taken by countries like the United States or the Eurozone or Japan have a much greater international spillovers than in the past. And you have capital outflows from the advanced economies that are looking for higher interest rates elsewhere, and they go to the emerging markets, pushing up the value of their currencies. So you have a situation in which there are strong reciprocal accusation of competitive easing, so the monetary policy is done for competitive purposes, to increase exports, and the risk of currency wars. So the fault lines, in my view, are precisely in this area, because there are diverging approaches that have been pursued, to deal with the international financial situation by the G7 countries, basically the major industrial countries, and the major emerging economies, to cope with the monetary spillovers, the financial boom and bust, and the currency oscillation. So quickly, the G7 approach is that, each country should keep its own house in order, avoiding internal and external imbalances. Monetary policies should be oriented exclusively towards domestic objectives, so they shouldn't really mind about international repercussions. Exchange rates should not be targeted, so should be freely floating, and capital mobility should be completely free and should be preserved. So the idea is that a greater transparency, a better communication of policy stances by the central banks should be sufficient to prevent excessive volatility and disorderly movements of exchange rates. And then, there is the idea that financial regulation should be more effective, and there should be also macroprudential measures to be adopted to deal with the risk of financial stability. So this is the approach of the major industrial countries. On the other hand, the emerging markets, chiefly, China, but all the other countries that are now part of the global financial market, of course, they agree that they should keep their own house in order, like the G7, but they also think that they need to adopt strong defenses against financial and exchange rate disturbances coming from the outside, because their financial system are less developed and they need to be protected from these external impulses. So they believe that rather than accepting the idea of floating exchange rates, they really believe that foreign exchange market intervention needs to be used to limit the appreciation or the depreciation of their currencies. Also, they believe that they should have capital controls and a strong macroprudential measure to be used to contain the impact of capital inflows, outflows on the domestic banking and financial sectors. And then they also believe that they should accumulate large foreign exchange reserves necessary to counter risk of sudden capital outflows. Now, the impact of this, I think, have led, in my view, to an inefficient management of the international monetary system, as it has been seen by the limited impact on the frequency and intensity of financial cycles. We continue to have periods of high instability in international financial markets. Then there are risks of trade protectionism and financial fragmentation. for the reason, particularly as far as the macroprudential measures. There is evidence that they're actually increasingly being used to ring-fence domestic banking and financial system. The accumulation of official reserve for precautionary purposes has a negative impact, a deflationary bias on the world economy. These are, the huge amount of reserves that are kept by a lot of the emerging economies could be spent to promote investment in their domestic economies. So, and despite of all this, risk of financial instability have not really abated. The IMF at the recent annual meeting indicated that these are still important. There are vulnerabilities in the emerging markets, even in the industrial countries. There are legacy from the crisis and also weak market liquidity. And the problem is that, the G20, which is the sort of the principal forum for international cooperation, has not been really able to reconcile the diverging approaches from these different member countries. And here I list some of the issues that are still pending. The reform of the IMF that has not been agreed, which was supposed to give a greater weight to emerging economies, in particularly to China in the voting of the IMF bodies. No progress in international macroeconomic policy coordination. There is support for capital flow management, but this, of course, entails the risk of financial fragmentation. And also, the reform of the global financial regulation by the Financial Stability Board is still incomplete. There is still little progress on full implementation, and also on the shadow banking and the derivatives trades. And also the trade liberalization, as has been already mentioned by Romano Prodi, has not been moving forward as fast as one could have expected, and trade growth is lagging behind. So I think a new approach is required. Basically, my view is that the G20 should really make an effort to strengthen international cooperation in the monetary and exchange rate policy area in conjunction with the IMF, because the IMF is now preparing the papers, the background papers for the G20, but is not really acting as a full-fledged secretariat of the G20, and does not really have a role in making policy proposals. It's just making suggestions. So I think, in my view, it would be important that under the G20, and they should really look at this as a big challenge, particularly next year when the chairmanship of the G20 falls on China, has been led by Turkey for this year, and of course Turkey has had its own problems. I mean, with the chairmanship of China, there is indeed a chance that some of these issues would be taken more seriously. And so I think the idea would be to create a multilateral consultation procedure to include financial stability consideration in the formulation of monetary policy strategy, to take into account also the impact of international spillover of national monetary policy measures, and also identify measures to limit the scope for exchange rate volatility in relation to changes in the monetary stance of major countries. Now, I mean, you are experts in this area, and you know that even if the Fed thinks of increasing the federal fund rate by 20 basis points, the risk is that the dollar appreciates by 10% vis-a-vis major countries in the rest of the world. So I think this is a quite disproportionate increase, and should be taken into account. At the same time, the Financial Stability Board, again, should complete the financial regulation reform, but also should be given the role to monitor, together with the IMF, the implementation of what has been called the capital flow management measure, which is a very vague wording, which, of course, implies capital controls and measures to limit the sort of the movement of capital for investment, productive investment purposes. So in conclusion, my view is that the G20 still has an important role to play, has not played that role so far, but with this proposal to have an enhanced consultation and monitoring procedure, I think we should aim at providing what is called, what I would call a multilateral forward guidance, to global financial market that should cover both interest rates and exchange rates, with the objective of minimizing the risk of destabilizing spillover and financial cycles. And also, this should allow to reduce the scope for regulation with the aim of promoting its simplification and rationalization. Because I think now there has been too much emphasis on financial regulation. I mean, everybody knows that, for example, the Dodd-Frank Act of the United States is 2,500 pages long. And, I was told by a friend of mine who works in a major global bank in the United States that their submission to the regulators of documents required under the new regulation is over 100,000 pages. Now, I don't know who is going to read these 100,000 pages, and it looks basically as a major sort of paper cycle that does not really achieve much in terms of reducing the sources of instability. So, I mean, if we manage to do that, then I think the growth prospects for the global economy will be enhanced if there is a credible commitment of the G20 to pursue stability-oriented macroeconomic policies, because this is what has been, in my view, missing until now, and everybody perceives in the financial market that each country has basically a domestic agenda in mind, and there is little consideration for the global repercussions. But as Romano Prodi has already indicated, the global players, I mean, the United States, Europe, China, Japan, cannot really operate in a vacuum without thinking about the international repercussions of their actions. So I think this is a big challenge. I'm aware of the difficulties to promote cooperation in these very difficult areas, but as I said, we now have, I think, a strong vested interest in sort of reviving economic activity worldwide, promoting investment, and it's not possible to do it unless we have a framework for macroeconomic and financial stability. So that's all I have to say. Thank you for your attention.